Before we begin this presentation, please read this disclaimer. Take your time, pause this video until you're finished, and then we'll begin. We are real estate investors. We like to buy properties and rent them out. This is our cash flow strategy and our retirement strategy. We like to buy distressed properties with borrowed money, and then typically we repair them so that we can rent the properties out to tenants. Everybody wins. We help sellers because they can sell their properties and move on with their lives. We help regular people obtain affordable housing. We help lenders like yourself find a way to achieve above average rates of return. We help neighbourhoods by bringing them up when we repair and remodel all of the old dilapidated houses. We help our schools and our local government by paying any past due taxes and increasing the property tax assessment on the houses we improve. We help contractors by giving them jobs. We help our local economy by purchasing products and services. Last but not least, we help ourselves, the investors, by creating cash flow for ourselves and the potential for a retirement. We do almost all of this in declining neighbourhoods, increasing the value of these neighbourhoods. The core beliefs of the rental strategy or the buy and hold strategy is that people will always need a place to live, that property values in general will appreciate over time, that rents in general will increase over time, and that by doing this we can take advantage of tax depreciation schedules and minimise our taxes, and that consistent cash flow is life-changing. It's very important to know how to verify the value of a property. It's both important for you as the lender and for us as the investors. We like to use licensed professionals to help us verify the value of properties: appraisers, brokers, and real estate agents. All three of these professionals will use comparable sales in the area, typically in the last 6 months, to establish an average price per square foot for our properties so that we can plug this in and find an estimated value. The professional broker will do a broker's price opinion, or BPO, and the real estate agent will do a comparative market analysis, or CMA. They are all based on comparable sales in the last 6 months. There are some important criteria that you as the lender will want to be aware of. First is the loan to value, or LTV. You arrive at the LTV by taking the loan amount and dividing it by the value of the property. You'll also want to understand your ROI, or return on investment. You can find this by taking the annual income and dividing it by the total investment. Let's go through a typical example using actual numbers. Take this house on 3rd Street. We've established that the comparable rents in the neighbourhood are $1,150 per month, and that the after repair value, or ARV, for this house is $100,000. So we make some offers on this house and we get an offer accepted at $50,000. This means we're going to buy the house for $50,000, but it's going to need $18,000 in repairs, and we're going to borrow an extra $2,000, which I'll explain later. So the total investment by the time we're done fixing this house up will be $70,000. So why do we borrow the extra $2,000? Well, it's because finding a motivated seller and finding a discounted price or a discounted house costs money. Finding discounted houses is not free, and on average it costs about $2,000 to find this kind of property. So here's what the total investment of $70,000 is going to look like when we borrow it. We're going to borrow it at 8%, so the loan looks like this. $70,000 borrowed at 8% interest only. It's a non-recourse loan, and it's a collateral-only loan. And the outgoing interest payment is $467 per month. This lending entity will loan $70,000, and they will be in the first lien position. Again, you take the $70,000 and divide it by the value of the property, and that's how you get the LTV. Can we agree that 70% LTV is more than fair for this lending entity? Can we agree that this lending entity is in a reasonably safe risk versus reward position, given the collateral? If you're still not sure, here's what the total liabilities look like. The principal and interest payment is $467 per month. You add the taxes and insurance, and the total liability per month, principal, interest, taxes and insurance, is $620 per month. So 3rd Street by the numbers looks like this. Its ARV is $100,000. The rental income is $13,800. There's going to be some expenses, but we don't know exactly what they are. So we're going to estimate 15% of the income will go towards the expenses, meaning we're going to subtract an $1,800 contingency. We're also going to have to subtract the annual principal, interest, taxes and insurance payment of $7,440. So the estimated annual cash flow for this property is $4,560. So in the end, 3rd Street will result in an annual cash flow of $4,560 plus appreciation and plus the benefit of depreciation on the taxes. As per the National Association of Realtors, on average the price of existing homes increased by 5.4% annually from 1968 to 2009. Based on the NAR's appreciation averages, in 5 years this property will be worth $134,000 plus. In 10 years this property is worth $175,000 plus. Imagine having 5, 10, 15 of these or more appreciating like this. Do you see how and why this business is a safe and stable retirement plan? I'd like to thank you for taking the time to watch this short presentation.